Oh, you just talk about the weather. Why not?
Yeah, I was thinking before this podcast, I was like, how can we not talk about the weather this week? Just anything else. Hey guys, and welcome back to the Young Investors Podcast. We're back again with episode 44, and joining me, as always, on the weather podcast. We didn't talk about... Well, I mean, I just brought it up, so yeah. We are going to talk about the weather. But how's it going, Brandon?
Yeah, I'm going pretty well. Just working away on the channel. How are you going?
I'm good. Yeah, YouTube's been going well. Posted a video this morning. I found the secret to YouTube. You just put Warren Buffett's name in the title, and
you really have.
You make
you really have. It's remarkable how well those videos are doing for you. I'm glad, but it's crazy. It's just like some of I think it's like 3 of your most viewed videos have come in like the past 4 weeks or something like that.
Yeah. I mean, people seem to just love hearing about sort of specific things that Warren Buffett has done in the past, or an interview that he's done that maybe a lot of people haven't heard about. So I'm just going to continue to feed my audience little snippets of Warren Buffett. So yeah.
Or you could go over to the great channel Aussie Wealth Creation, where we talk about Charlie Munger.
I wouldn't recommend it.
No, I mean, that
was a really good video you did.
Thanks. It's a good little clip, that one that I chucked in there. It's only like a minute long, but it's super powerful. It's just, he covers all bases, and he just does it like cool, calm, and collected. It's just like, this is what you got to do.
Yeah,
but yeah. Definitely. Anyway, in this video, what we're going to be, or in this podcast, I should say, what we're going to be talking about is something that I actually got a comment on the last podcast, is talking about making money in recessions and when stock market's going down and that sort of stuff. So I made a video this week about Inverse Etfs. So we're going to be discussing Inverse Etfs a little bit more in this podcast, and we'll also talk about short selling and just in general the ways that you can still make money even when stocks are doing really poorly or going down. So we'll talk about that. We've got some news stories to get through. We've got our indices as always. And we do, if we've got time, we've got some Q&A questions from you guys. Of course, if you've got a Q&A question, if you want us to answer a particular question that's on your mind, make sure you just drop it in the comment section on YouTube. But with that said, should I fly through these indices?
Yep, go for it.
All right, so we've got the Dow Jones. This week was down 1.1%. S&P was down 0.6%. NASDAQ was down 0.2%, which is interesting because a couple of days during the week, we had some really quiet negative days for those indices, didn't we?
Yeah, at least one of the days was 3%.
Yeah, something down. Like 3%.
So, yeah, it seems, and we'll talk about why in one of our news stories, but... we had the ASX, which was down. Of course, the ASX is actually down
always
for the
tanks
week.
Harder.
Down 2.8%, and then the All Ordinaries down 2.7%.
Yeah.
So, yeah, bit of a negative week for the markets. And I think most of it sort of happened at the start of the week. And that's kind of related to something that happened in the markets, which was there was a yield curve inversion. So there's 2 sort of bonds called the 10-2 spread, and the spread between them, there's a thing called the 10-2 yield curve, and it inverted for the first time since the global financial crisis and that recession back in 2008. So you've probably been hearing a lot about this, but maybe some of you don't understand what it actually means. So I thought I'd just maybe spend 2 minutes explaining what it is.
I always have to rack my brains and think about these different yield curves and trying to remember what it's actually telling me. So yeah, go through it.
Yeah, definitely. And so normally in normal conditions, normal market conditions, the yield that you can get, the return that you can get on a 10-year bond will be higher than the yield on a 2-year bond.
Makes sense.
It kind of makes sense because the longer you have to wait to get your principal investment back, the initial investment back, the higher risk is associated with it because you're waiting longer, there's more uncertainty in the future.
Yeah, you'd want a better return.
Definitely, yeah. So what happens when there is a curve inversion? Well, essentially what that means is that the 2-year bond is now offering a higher return, a higher yield than the 10-year bond.
Jeez, okay.
And essentially this means that investors think the economy is going to be riskier in the short term than over the long term. So it's kind of a flipping of that script where traditionally the longer you have to wait for your money, the riskier it is. And it kind of represents a sentiment that the market thinks that it's going to be riskier in the short term.
Right, interesting. So people are right now they can get a better deal on locking their money down into a 2-year bond. Is that right?
Yes, and essentially the reason for that is, what happens after this yield curve inverts is that there has traditionally always been a recession soon after. The average is 2 years after. So the last time that the curve inverted, that this happened, was in 2006, at the start of 2006, and then about 18 months later, the global financial crisis and the recession began, and essentially markets reacted pretty strongly to this earlier in the week, and a lot of stocks were selling off quite heavily, and on average, there was a day where the markets went down 3%. I think that was that day that the curve inverted. So clearly, people are worried about this. I mean, you've probably seen it on the news and in pretty much every single article. It's been pretty much everywhere at the moment.
Yeah, it's weird. It's interesting how there are all these little indicator signs that there's a recession coming. Of course, you can't really put too much stock in any single one of them, but it is interesting. And I believe in history, I'd have to go back and have a look, but it seems like before each major kind of recession, you do get this yield curve inversion. So it seems to be, people seem to respect it as a fairly strong indicator of bad times to come. So yeah, I don't know. So it says that usually within about 2 years is when the effects, you start seeing that in the actual market. Is that what you said before?
Yeah, I think the average is about 2 years is how long. Every time this a yield curve has inverted, there has always been a recession that's followed it.
Right, okay.
So, but usually within about 2 years. So
right, I'm just putting it in my calendar.
2 years today.
All right, cool. 2 years. Sweet. 17th of August 2021. That'll be the day.
That's the day.
Jeez, imagine if that actually happened. You're just listening back to this podcast one day in the future.
Wow.
He predicted that. That was amazing. Anyway, what else we got? We've got just some pretty boring stuff. Seven West Media now has a new CEO. So the report here reads that Seven West Media Chief Executive Tim Warner has resigned with immediate effect after 6 years in charge, with Chairman Kerry Stokes saying now is the time for change. James Warburton, who had a short-lived spell as Chief Executive of the 10 Network, and quit as the APN outdoor boss last year, has replaced Mr. Warner as CEO and Managing Director. The quote from Stokes is that all parties agree now is the time for change. I always wonder with those quotes, all parties?
Yeah.
Did they all agree? Let's be real here.
Yeah.
But just having a look at what this caused, it seems to have caused the shares to bounce up by 6%, but then again, 6% rise, that's from 38 cents to 40 cents per share. And this caught my attention. Seven West Media has a current PE ratio of 4.47. How low is that?
That's insane.
Yeah,
clearly the investors in the market are expecting earnings of the company to decline or not grow very much from here.
Not do much at all. Yeah. So that's the only thing I had to say about Seven West Media. It's not a company I follow at all, but for some of you guys out there, might be interesting. And then there's a article that just kind of grabbed my attention about General Electric fraud. So the article here reads that General Electric shares have plunged as much as 15% after an accounting expert who exposed Bernie Madoff's Ponzi scheme accused the company of fraud, an allegation the industrial giant strongly denied.
Really?
Fair
they
enough.
denied it?
Yeah, no, they just came out and said, you know what? Tell you the truth.
You got us.
Yeah, we're spent. So what's his name? Harry Markopoulos, who warned securities regulators about the Madoff investment scheme years before that firm went under, accused GE of running a decades-long accounting fraud. According to information on, get this, gefraud.com, a website set up by Markopoulos and his associates. So in a 175-page report, Mr. Markopoulos claims that GE's US $38 billion in accounting fraud amounts to over 40% of GE's market cap, making it far more serious than either the Enron or WorldCom accounting frauds.
Wow.
Well, big claims,
Yeah,
But
I'll have to look into this. I really find these kinds of stories really fascinating, like Enron's story or WorldCom. It's very interesting. So I'll have to jump over to gefraud.com. I wonder how much he paid for that domain.
Yeah. Oh, who knows? Who knows? I would imagine it'd be particularly sought after domain.
Not until now.
Yeah, exactly right. gefraud.com, but it might be worth looking into. Yeah, it's interesting how companies with dodgy management teams, they're still doing some interesting accounting stuff even today.
Yeah.
Yeah, where you would expect that maybe the what am I looking for? The entities that look into this and audit this sort of stuff would be much stronger perhaps today than what they were in yesteryear, but it's still can happen.
Definitely can still happen. Absolutely, yeah. So with those news stories completed, should we move on to the main section of this podcast and start to talk about some of the ways that we can make money when the markets are falling? So
yeah, sounds good.
Yeah, I mean, it's when the markets have been going up consistently for so long. It's not that difficult to make money in the markets, I guess. Most stocks have been going up, and it's Warren Buffett or Charlie Munger saying where it's only when the tide goes out that you see who's swimming naked.
That's exactly right.
And let's talk about how we can make money when the markets are falling. So
yeah, sure.
The first one we had was short selling. Did you want to run us through what short selling is?
Yeah, sure. So I've just written this quickly. So short selling is, as we were just saying, a method of profiting from a given company's share price going down. So the way that it works, it's a little bit hard to wrap your head around. So I'll try and explain it fairly simply. Tell me if I don't make sense. But you know, when you normally invest into a company, you buy the shares low, and then later down the track you try and sell them high, right? So you buy low, sell high. Whereas with short selling, what you're actually doing is you're selling first, and then you're buying later. So what you're trying to do is you see that a company's shares are really high. So although this doesn't make sense yet, what you do is the first thing you do is you sell the shares when they're really high, shares that you don't have. And then what you do is hopefully the shares will go down over time. You think that they'll fall. And then once they do go down, you then buy them back when they're very low. And to do this, what you have to do is you go through your broker, and because you don't own the shares, so you can't sell something you don't own, what you do is you borrow someone else's shares, right? So you're borrowing someone's shares and then you sell them immediately, right, at the high share price. And then if all goes well, the share price will fall. But because you've borrowed the shares from someone else, you have to give them back, right? So you've borrowed them high and then you've sold them, and now the share price has gone down, right? So then you buy the shares back cheaper and return the shares back to the person that you borrowed them from. Okay? So in that case, what you've done is you've taken their shares. Thanks for the loan, mate. Sell them when they're really high. You buy them back when they're really low, and then you make the profit of the gap, the gap in between. So if you buy the shares back really low, okay, and you've sold them really high, then you make a big amount of money. You return the shares, and then all of that process is finalized, it's all finished, and then you've made money in between the point where you've sold high and you've bought back low, if that makes sense. Does that make sense?
Yeah, I think you explained that really well. It's very confusing, and the first time you hear this, it's probably not going to make any sense. But
No.
It's a way of basically just inverting the market. Basically, if stocks go down, you're going to make money in the complete opposite way that you normally would when you just traditionally buy ownership into a business.
Yeah, and I was going to bring up the only couple of things that you need to consider here with short selling is that if you want to be a short seller, then you have to open a margin account, and that's a little bit annoying because what happens is when you take up a short position, then one of the risks is that you can make unlimited losses. So if you had a normal investment in a share in a company and the share price went to zero, well then you've just lost 100% of what you put in, right? But that's all that you can ever lose. Whereas if you were to get short selling wrong, where you've borrowed and sold first, and then you're trying to buy back lower, but the share price instead just keeps going up and up and up and up, well, there's no limit to how high shares can go, right? Whereas you can only go down to 0, but you can go up to whatever. Say you initially sold the shares for $10 per share, they could charge up to $100 per share. They could keep going to 1,000, or you could get a Berkshire case where each share's worth $300,000. So in that situation, the amount that you can lose is not capped. So you're opening yourself up to potentially unlimited losses, but eventually it gets to a point where you get a margin call and you have to keep putting in more of your money just to maintain that short position.
Yeah. And doing short selling in the traditional sense where you just borrow and your risks are unlimited is extremely risky, and I don't think most people would ever do that. Most people won't ever short sell at all, but there is a way that you can short sell and limit those losses to make it a little bit less risky. Still risky, but limit the risk to having a cap rather than just being unlimited.
Right.
And the way that you do that is with derivatives. So there's a financial instrument. It's like a vehicle that you can use to invest, and it's called a derivative. And one of these is called a put option. So I'm going to try and explain this.
Yeah, basically with derivatives, this is the way that I like to think. I just think about the word that it is, derivatives, so derive. So derivatives are just contracts that derive their value from something else happening. So it's not actually to do with the derivative itself. The derivative has value from something externally happening, if that makes sense.
Yeah, that's a really good way of putting it.
Yeah.
So essentially, a put option is a contract that gives you the right, but not the obligation to sell a stock at a predetermined price. So you have the right, but not the obligation to sell a stock at a predetermined price. So let me give you an example so that this might make a little bit more sense.
Yep.
So you might have a put option that has a strike price of, say, $50 per share. So that's the price that you have the option in the future to sell the stock at.
Right.
The right, but not the obligation.
Right.
So let's say that the stock now falls to $30 per share. You can go ahead and execute that contract, and you would buy the stock at $30 per share, the low price, and then you would sell it at the higher price of $50 per share that you had the contract for. You had the right. But let's say that, but the good thing about sort of put options is that if the stock goes higher, let's say to $100 per share, you don't have to buy high and sell low. So remember, you had the right, but not the obligation to sell at $50 per share. So you can just choose not to execute the contract, and then your loss is limited at the price that you paid for that contract, which is usually about 1% of the stock price. And I think the best way you can think about this without getting confused is just to think of it as insurance on your stocks. So if you buy insurance basically through the put option, and if your stocks go up, then that's fine. You just have to pay the premium, the price that you paid for those put options. And then if your stocks go down, you can profit from the decline and recover some of your losses.
Yep. No, that makes sense. I think you explained that well. That makes sense to me. And I haven't really looked into options much before.
Yeah, I haven't either myself. It's not something I'm particularly interested in. But some people like to use them, and that is certainly one way. I think if you are going to be short selling, if you're going to be trying to bet that a stock is going down, which I don't think I would ever do, just because of how uncertain the markets can be, especially in the short term. Derivatives, put options and call options, they're very short term instruments. You're looking in the next 3 months or the next 6 months maybe. So you're talking about short term price movements, which is something I think both of us just try and not deal with at all. But if you are going to be doing it, then this is a much safer way to do it rather than having those unlimited losses. So with short selling out of the way, the next way that we can make money when the markets are going down is a thing called Inverse Etfs. Now, you made a video on this recently, didn't you, Brandon? So do you want to run us through what an Inverse Etf is?
Yeah, sure. I did. I made a video in the last week, so if you wanted to check that out with some visuals and stuff, then feel free to head over to my channel. But what an Inverse ETF does is it's a exchange traded instrument, investing vehicle, and what it does is it aims to achieve the opposite daily return of a particular index. So basically, QQQ is the example that is the NASDAQ 100 ETF. I use that as an example in the video. And so that directly, if the NASDAQ 100 goes up by 1%, then the QQQ also goes up by 1%. But then if you have a look at a different one called PSQ, if, say, QQQ went up 1%, then PSQ goes down 1%. So what PSQ is the Inverse ETF of the NASDAQ 100. So it's basically, as I was saying, it's a way to achieve the opposite daily return of an index. So the important thing to understand here is that although they're called inverse ETFs, these inverse ETFs don't hold stocks, as the name may suggest. They are instead investing tools that are constructed. They're literally built using various derivatives, like what we were just talking about, like options or swaps or futures or whatever. So they're like literally mathematically constructed so that if this particular index went up that amount, then this inverse ETF would go down that same amount. But it's only for that one day. So it only happens on the same day, right? So if you held this inverse ETF for like a week or a month or a year, you would not get the inverse performance of the index over that time. Typically over the long run, they underperform, right? So yeah. So it's on a day by day basis. So if I looked on one specific day, the return of that inverse ETF would be the opposite of that index. But if I looked over like a 4-week period or a 6-month period or a 12-month period, they would not get the exact inverse performance. And the reason for that is because they're built up using various derivatives, and they get rebalanced every single day so that in the next day, they're set up again to ensure that they can pretty much exactly get the same opposite return on the index of that day. Does that make sense?
Yeah, that's it's really interesting actually how they kind of construct them using these kind of just extra financial instruments that financial institutions have kind of developed in order to do this. And I hadn't really thought about that. So every single day on a particular day it will be inverse, but over a very long period of time it won't be exact.
It won't
That's
be.
really
And
interesting.
that's because at the end of the day, it gets rebalanced for the next day. And then, the next day, it will get that day's daily return, but then it gets rebalanced again. So what you actually see is, over the long run, if you look at like an inverse ETF chart over 12 months or however long, like a decent period of time, you actually see they underperform. They don't do very well at all because that's not what they're designed to do. They're not designed to be something that you hold for a long period of time. In fact, basically every financial institution out there says, they have like a statement on inverse ETFs, is that this is a short-term strategy only and you should not hold these. It's not recommended that you hold these for much more than a week or two, basically, because they're designed to just do that thing on that one specific day. So for a long-term investor, they're pretty useless. Like, you don't want to hold them for a very long period of time. But for like someone like a day trader or a very short-term investor, they're magic. Because you can just, if you see all the indicators flashing red that the market's going to go down, then you can just jump into these for a day. And, if you get it right, then that's perfect. But you could also get it wrong at the same time. So there's that to consider as well. And that makes it difficult because you can't try and hang in there for multiple days where you haven't had the market decline that you thought, because then it just it gets worse and worse, kind of thing.
Right. So what are the advantages of sort of using one of these instruments?
Well, the advantages are you don't have to short sell. So the advantages are that you don't get the disadvantages of short selling. Right. So like for short selling, obviously you can lose an infinite amount, you can lose an infinite amount of money potentially. Whereas because an inverse ETF is still exchange traded, if I put like $100 into or $1,000 into one of these inverse ETFs, the maximum that I can lose is $1,000 because I'm just buying into the inverse ETF.
Right.
Yeah. They're also exchange traded, obviously, which makes it really easy to buy. So they're quite convenient. You don't need a margin account or anything like that. And it's a very simple way to just take a position against the whole market. However, they also have disadvantages, which we're just talking about, where if you hold them for a long period of time, they typically underperform. So they're not suitable to be held for a long period of time. They only work on literally a daily basis. So you also find that the fees are a bit higher than, say, a typical ETF. The fees are more like 1% usually, as opposed to like 0.1 or 0.15% or something like that.
Right. Okay.
And then one more thing that I just chucked in here that I wanted to talk about is that with these inverse ETFs, a lot of them actually are what we call leveraged inverse ETFs, where, again, they go against the index, but they're amplified. So, for instance, you can have a normal 1-to-1 inverse ETF, where if the index goes up 1%, or if the index goes down 1%, then the inverse ETF goes up by 1%. But you can also have like a 2-to-1 leveraged inverse ETF, where if the index goes down by 1%, the inverse ETF will rise by 2%. So, yeah, it gets quite complicated, but it's just important to understand that you know what pace your inverse ETF is moving at. So, for instance, in Australia here, we've got Bear, which is the Beta Shares Australian Equities Bear Hedge Fund. So it says here that a 1% fall in the Australian share market, this is the ASX 200, on any given day can generally be expected to deliver a 0.9 to 1.1% increase in the value of the fund, and vice versa. So that's a 1-to-1 inverse ETF. But you've also got BBOZ, which is the Beta Shares Australian Equities Strong Bear Hedge Fund, which says a 1% fall in the Australian share market on any given day can generally be expected to deliver a 2 to 2.75% increase in the value of the fund, or vice versa. So BBOZ in this case is more or less roughly a 2-to-1 leveraged inverse ETF.
Gotcha.
Where it's going to amplify whatever happens in the market. But it could be positive or negative.
Yeah, and I guess if you're going to be a day trader or anything like that, that kind of makes a lot more sense, because you're going to be wanting to see more, because overall these big ETFs, they don't move that much. So by amplifying the returns, just a small movement could result in a significant movement in the value of these funds, I guess. I love the names as well. Strong Bear.
Yes, Strong Bear. Grrr. It's pretty funny. I was just going to finish off as well with that example I was using before with the QQQ, the NASDAQ 100 ETF. PSQ was the 1-to-1 inverse ETF of the NASDAQ 100, whereas QID is the 2-to-1 inverse ETF of the NASDAQ 100. So that's the American NASDAQ example as well. But yeah, that's inverse ETFs pretty much. They're pretty cool because they're exchange traded. They do get the opposite return, the daily opposite return of the index. But yeah, you just have to remember, you just have to understand what pace they move at, and remember that they give a daily inverse return, and you don't hold them for a very long period of time.
Yeah. Okay. All right, so we've talked about short selling and inverse ETFs, and I guess, I know I'm just going to insert my opinion here, but I don't know about you, but for me personally, these two so far would probably not be something that I would use, just because of the investing principles that I follow, but of course it's always interesting to talk about them.
Yeah, I guess we just don't really... We obviously invest quite similarly, and we're just long-term investors, and neither short selling maybe, but there's risks, and then inverse ETFs are not designed for long-term investors, so it just doesn't work with how we kind of go about things.
Yeah, exactly. So what I thought, sort of just to finish up this middle section, I thought we'd talk about sort of a strategy that maybe both of us, I certainly would be using this strategy in order to try and make money when the markets are going down. And that method is by holding cash. And that might seem a little bit strange. How can you make money when the market's going down when you're holding cash?
Cash never wins, grrr.
Yeah, exactly. But essentially, the method that I use in order to be prepared for a market recession or a crash or something like that is to have cash at the ready to be able to buy great businesses at bargain prices.
Yep.
So essentially, naturally at this point in the economic cycle, it's likely that if you're a value investor or you're following the Warren Buffett kind of principles, that you will be sitting on a larger than average pile of cash. And the reason for that is simply because there's very few opportunities in the market to invest for a high return. Valuations are significantly higher than the average over time, and that essentially means there's less opportunities to make those high returns, to invest and be confident that you're going to make a significant return, a double-digit return over the long term.
Yeah, I'll just jump in real quick. Everyone in the comments section is always, when we talk about this, they always say, oh, why are you holding, that's such a silly strategy to be trying to hold more cash. And this is classic, because we're not trying to hold more cash. Like, in an ideal world, like, what we're doing is we're just following our strategy, right? In an ideal world, we're following our strategy, and we do get to invest all of our money in, great businesses at margin of safety prices. But what you find is we're not specifically just trying to stockpile our money. What we're doing is we're still trying to follow the strategy of finding great businesses, buying at margin of safety prices, but we can't do it. We're not finding those opportunities. So it's not like we're trying to stash cash. It's the fact that we're still following the strategy, but the strategy is not giving us any opportunities. So naturally, as you just said, naturally we are starting to accumulate more cash. So it's interesting that even if you just continually follow the strategy, it actually protects you in periods where the market is extremely high, because you're not going to get those opportunities.
Yeah, and you're likely going to be selling some businesses that are outrageously overvalued. Not everything's going to get outrageously overvalued, and you might just hold on to it and be sort of more of a buy and hold. But some of the businesses in your portfolio will become just ridiculously overvalued because of some kind of hype around the business, or they've had a really good run of growth and everyone's expecting that to continue into the future. And then you would start to sell some of those off, or maybe sell some of those and move into some other positions. And yeah, you're exactly right. We're not trying to sit in cash. I would rather not be in cash, but there's nowhere I can see that I can deploy all of it right now and get a really good return. Like, bonds are offering like 1%, and many stocks are offering like 3 to 5% if you're being conservative, which is just terrible. So I'd rather sit in cash. And traditionally, historically, when valuations have been this high, there has been a correction in some point in the near future, which gives me confidence that there's going to be somewhere to deploy that money. But essentially, that means that this is the perfect time to make sure that you have a solid watch list of really great businesses. And we've spoken about what defines a great business using the Warren Buffett principles on this podcast and in our videos many times. Essentially, there's three key areas that define a great business. The first is that it has to be a business within our circle of competence, has to be one that we understand, one that we're passionate about, a business where our values are aligned with the values of the business and its long-term aspirations, I guess. The second thing is that the business needs to have what's called an economic moat, some kind of competitive advantage around it, protecting it over the long term. And then it also has to be run by a great management team, a management team that is honest to its shareholders and transparent, and also very good at their job, good at investing within the business and managing debt and making decisions that are going to impact shareholders. And those three factors kind of define what a great business is. And then we have to do what's called intrinsic valuation, or calculating the margin of safety price, where we need to estimate how much to pay for them, because businesses are going to produce a finite amount of cash. It's a particular amount of cash. So the price that we pay also has to be finite. And it has to be significantly less than what we're going to get out of it.
That's Charlie Munger right there.
Yeah, that's pretty much exactly what he says in that short clip, is just those 4 areas, and they're very simple, and they're just, it's crazy that investing for many people becomes this huge complicated task with all these indicators and derivatives and all of this stuff, and the really greatest investors just focus on the fundamentals. And it's interesting, because that's kind of true for the best people in kind of any arena. If you think of like the best basketball players, I just thought of this, they will always say that it always comes down to the fundamentals. Like, it's not about what fancy things you can do. It's about being really, really good at the fundamental core components of basketball in that case. And in this case, I guess, investing.
Just be really good at the basics. Just do the basics really, really well. Yeah. Well, that's it. I mean, Warren Buffett, what is he? Is he top 3 richest people in the world or something like that?
Yeah, something like that.
he doesn't mess around with all these different, day trading things, charts and candlesticks and blah, blah, blah. I mean, he literally just, you hear interviews of him and he's saying he spends most of his day just reading. He just reads and reads and reads. He doesn't do anything. He's just reading like annual reports. He's reading articles and whatever and just educating himself. And he just sticks to the fundamentals. I mean, he just goes circle of competence, moat management, margin of safety. And he obviously does a hell of a lot of reading, a hell of a lot of research, but he sticks to just those 4 basic points. He's not messing around with, timing the market or this and that. He doesn't care about it. He just focuses on the basics. He does them right. And it's certainly worked for him.
Yeah, I mean, of course he's made mistakes, but on average, just following these 4 areas, and instead of just trying to incorporate all of these indicators and all of these things that people are throwing at you, Wall Street's throwing at you, and financial advisors throwing at you, just going really deep into each of these and just trying to rationalize and answer each of those questions, which is really, do I understand the business? And then diving in, like, do I understand what products they're selling? Do I understand how their supply chain works? Do I understand this? And just keep asking questions until there's no more questions to ask. And that's really essentially what they do.
Yeah.
And by doing this, by holding cash and having a great list of businesses that you understand and having a price at which you're willing to start buying it at, as stock prices fall and people are running away from the market in fear, you can be ready there with, what does Warren Buffett say, with your wash tub?
Yeah,
and,
exactly.
Ready to pick up businesses at cheap prices that people don't want because they're scared of the market.
Yeah. It's when it's raining gold, you want to have the wash tub, not the thimble.
Yeah.
And that's it. If you have some cash on hand when it starts raining gold, then you're out there with the wash tub. And, if you're someone that's, I'm just always going to be 100% invested, well, then when, it starts raining gold, well, what you'll be thinking is it's when shit starts hitting the fan. But really, it's when it starts raining gold, you're only going to have that little thimble out there. You won't be able to capture all those companies at really good prices. So, yeah. It's definitely a strong argument when things get real hot in the markets to have some level of cash. I know a lot of people do disagree with me on that, but really strong argument to say that you should have some decent levels of cash when things are obviously really hot, really overvalued in the markets. But
and I just want to touch on, I think you touched on this just before, but I get this comment a lot, and it's that, you shouldn't be trying to time the market because timing the market doesn't work. And I agree, timing the market does not work. Trying to predict when the market's going to fall and buy in at the bottom, sell at the top and buy back in at the bottom is absurd. And over the long term, it doesn't work. But that's not what this is. And you have to understand the distinction. We're not trying to time the market. We're not talking about selling an ETF at the top and buying it back at the bottom. We're just looking at an individual business and what it can produce. In the same way that you might look at an investment property and look at the price and compare it to the rent you're going to get. If the rent is so low and the price is absurd, if you're going to get $1,000 in rent and the price is $1 million, you're not going to buy it. It just doesn't make business sense. And that is just fundamentally what we're doing.
Yeah.
Is comparing what we get out of the business to what we're paying. And that is not timing the market. It's just being smart about where we're putting our money to ensure that we make a higher return over the long term.
You sound a bit angry. Sounds like you've gotten that comment a lot.
I'm very angry. It's just...
Breathe. Have a sip of water. How about we just move along into the Q&A? Is that okay?
No, but it's because I think the second biggest video I've made on YouTube was about why I'm holding cash.
Yeah.
So
I've got one that
naturally there's a lot of comments on there that disagree, and that's completely fine. Of course, I like disagreement. I actually really like people who share their opinions, even if they're disagreement, because I always like to know if I'm wrong. I really don't care if it's embarrassing that I've made a mistake. I want to know I'm wrong so that it doesn't continue to affect my portfolio or me. So
yeah. Just do it nicely.
Yeah, just don't.
That's all we ask. Just, you can agree to disagree, but just do it nicely.
You prick.
There's so many, the comment starts with, "You are an absolute idiot," and this is why I disagree with you. It's just like, okay, take out that first sentence and then just talk about why you disagree with me.
Yeah.
It's like, you don't have to just hate someone because you have a different opinion to them. Oh my gosh.
Yeah.
Oh, the life of being a YouTuber, right?
It's so hard.
You just got to always, I just try and now, if they're getting real offensive, I just delete them and block them from the channel because you just got no time for people that are just like offensive like that.
Definitely.
But if it's someone that's borderline, I just try and kill them with kindness. I just try and like, just be super nice in my reply and say, I value your opinion. Thank you for voicing it. This is why I think it differently and that sort of stuff. But anyway, YouTube life. This is what we talk about like after the podcast is finished.
Yeah.
We're like,
just rant.
Yeah, just YouTube stuff.
Anyway,
so yeah, that's kind of our section summed up on how you can think about making some cash, even in markets that are going down. So yeah, definitely, hopefully we've covered a fair bit that is of use to you guys. And now I guess we'll head into Q&A. Should we do it?
Yeah. So I'll pose this one to you. What do you think about Vanguard's diversified index ETFs as opposed to buying multiple different ETFs for passive investing? Is it potentially a good way to save on brokerage? I'd love to hear your thoughts.
Yeah, so with this one, I actually did a bit of research into this because I didn't know what they were, these Vanguard Diversified Index ETFs. So they're basically, they're ETFs in themselves, they're Vanguard ETFs, but each ETF includes multiple Vanguard index funds. So it's kind of like what the different super options are. You know how you can select balanced or high growth and that sort of stuff?
Yep.
Yeah, it's kind of like that, but as Vanguard ETFs.
Right, okay.
Yeah, so there are 4 options. You can get a Vanguard Conservative Index ETF, you can get a Vanguard Balanced ETF, a Vanguard Growth ETF, or a Vanguard High Growth ETF. So essentially they just break them down, they just balance these ETFs differently to try and hit the different objectives. So for the conservative option, it's a 70 to 30 income to growth focus. Balanced is 50-50, then growth is 30-70, and then high growth is 10 and 90. So you can see how they just kind of balance these ETFs differently. But yeah, the ETFs that you could buy into actually hold are the Vanguard ETFs, which is kind of funny.
Interesting.
So if you have a look, the balanced option, which is the 50-50 split for income and growth, it has the following. So in terms of growth, it holds the Vanguard Australian Shares Index Fund. It holds the Vanguard International Shares Index Fund. It holds the Vanguard, the Vanguard International Shares Index Fund, which is hedged. It owns the Vanguard International Small Companies Index Fund, and it owns the Vanguard Emerging Markets Shares Index Fund. Right. And then for income, it has the Vanguard Global Aggregate Bond Index Fund, and then the Vanguard Australian Fixed Interest Index Fund. So you can see how they're just like constructed with these different other index funds, basically. So it really is like what happens in your super account, where you select like high growth or you select balance and that sort of stuff. So if you weren't trying to perhaps track a particular index, which is like the classic what passive investors do, and you wanted just like more of a diversification across different funds, both some growth and some income, then sure, this could work. For me, that's not what I'm trying to do. So for me, they're not particularly interesting. The only thing that I would kind of say is that the fees with these ones are a little bit higher, so like 0.27%, whereas some of the ETFs that we've looked at in the past have been like 0.1% or 0.14 or 0.15%. So yeah, overall, is it a good way to beat brokerage? Yeah, it could be. I just weigh up kind of what your goals are and weigh up your brokerage versus what you're paying in increased fees and that kind of thing.
Yeah, that's going to be it, isn't it? Because that increased fee will continue to be a cost to you as you hold it over the long term, whereas the brokerage is kind of an upfront fee that you would be paying. So you got to balance those two and see which is it worth it. But yeah, it's certainly interesting. I think that's kind of a similar thing to what one of Ray Dalio's all-weather portfolio, I think, is. It's basically just a makeup of a bunch of different ETFs. And yeah, that's basically how he's built that. But yeah.
Should I ask you this one?
Yeah, ask me this
sorry.
question. We'll do one more question, and then we'll wrap up the podcast for the week.
Okay, how about I'll ask you this one. I'll ask you the third one then. All right, fast forward to retirement, time to sell. Say you're 60, 70 years old. Do you think you will sell all of your stocks, provided the market is doing generally okay at the time, and move your profits into lower risk, accessible options, e.g. accessible bank accounts, so you can use and enjoy your spoils of war without having to worry, even though you shouldn't be worrying with smart long-term based investments? Or do you think maybe you'll forever keep investing, be it just a portion of your wealth, into the stock market and watch over until your dying breath, passing it and your beloved spreadsheet onto your next of kin?
I love that.
It's such a well-worded question.
That is the best question I've ever seen asked.
I love it.
That's a good question, actually. I'm not entirely sure, but from what I sort of know now, I would probably say I'd continue to invest, but I would be much more weighted towards income investments, driven investments, safer income, fixed income, or other kinds of investments that have a much more consistent cash flow, such as maybe property, real estate. So, I mean, I would continue to invest. I think it just makes sense to continue to invest. And as long as those investments can pay you enough income, even while the markets might be down and the prices of those investments are down, as long as they can continue to pay you income, then you'd want to be continuing to invest over the very long term. And pass it on to my beloved kin. Yeah. There you go.
I also put this one in because I'm not actually sure what I would do, to be honest. I'm not sure, but I think you're right. I think there's a certain point where you've made your money in the market, and instead of, trying to wake up every day and research into different companies and try and find that next, 10 bagger or whatever it is, that you recognize that actually I've made a fair bit of money in this market and I should probably just focus on really protecting it now. So there's definitely an argument to be made switching to more just like lower risk, income maybe based investments. I think for me, to be honest, I actually think in the long run that while I'm young, I feel like I'll be doing a lot of investing, but I think that as I go on, I'll actually be running businesses. I feel like in the future, I'll make a couple of businesses to try and use my money to, do things or deal with things that I care about and that sort of stuff. That's like my long-term intention anyway. So I actually feel like once I make most of my money in the market, I'll actually try and get that money and grow my businesses or something like that. That's how I see it happening anyway. But
yeah, that's probably true. I can probably see that as well.
Yeah. So taking that money and just putting it to use to try and, because I personally just want to make businesses that like deal with the issues that I care about. So like if I've made my money and I'm like getting on a little bit, then I'll just try and like pump that money into making as big a difference as possible, I think.
Aren't you a good person, Brandon?
I hope so.
Save the world.
I try.
Yeah, so that's the podcast for this week, guys. Thanks for tuning in. And of course, as always, if you have any Q&A questions or topics you'd like to see us cover, then head over to youtube.com/Hamish Hodder and click on the video version of the podcast, and you can leave your question there. Thanks everyone for joining us today, and thanks Brandon, of course, for joining us as always.
Yep, no worries.
And we will see you guys next week. See you later, guys.
Cool. Bye-bye.